Let's get directly to the point, shall we? Nobody wants to know where I was for the 5 months or so, doing whatever I was, but a video was due, and this time we have decided, based on the people that wanted a video, that we are going to be making this thing in a video form. This is my 12 entry models tweet. Most of you may have seen it on Twitter by now, but if you haven't, then this is it. So there are 12 models, and today we are going to be going through 12 of them in obviously video form because text is eventually text and a little bit confusing. I try to make it as detailed as possible, but still it's text. So people ask for a video, we are going to make a video. So before watching this one, you should have already watched this one because the models are based on this video and this is on the channel, same thumbnail. It's about ranges, order blocks, supply and demand. The secrets basically says that what are the shortcuts? What are the shortcuts I use and what are the shortcuts most of the people that you see on Twitter use to identify these confusing order blocks and supply and demand zones. So further based on that are 12 of my own models that I'm using on a daily basis. And these are not just mine anymore. A lot of people use them, but there are different fancy names. We like to keep it simple, or you could say I like to keep it simple for myself. Or these may be confusing names for you, but these are simple for me because that's basically what I use. But most of it on Twitter or any other course is basically the same. This is actually like a course. This video is a complete course that gets sold for like $4,000 to $5,000 a piece easily. I don't know much about the market standards, but this is what they sell in these courses. This basic info, not so basic for a beginner because all of these fancy terms mess them up. So I'm just giving it for free because I don't need $4,000 to $5,000. I could just make it myself in a day. So let's just directly get into for the first model, call it the sell side liquidity. And you can just go to the tweet and read the text. I'm not going to read it. Just going to open this picture for just going to explain a bit. There's a trend in the range high, range low. There's a trend. There's a sell side liquidity marked here. There's a distribution mark. There's a sweep mark. There's this reclaim. There's the stick that says this could be the potential entry trigger. There's the first TP. That is the market structure, and there's could be the buy sell liquidity, just like there's the sell side liquidity over here. We're just gonna go to BTC right now, and on this BTC chart, first of all, for to identify sell side liquidity, you have to see where is the candle that looks like an outlier, a wick that looks like an outlier. In this whole range, you can see this specific wick right over here. This looks like an outlier. Why? Because the wick is larger than the body, actually a lot larger than the body. So if you do identify it a little bit in detail, we can say, where's my magnet? There's an order block here. Okay. So our first analysis is that there's an order block, price goes up. This is basically a basic SR flip here that needs BTC to do to reach almost like 53K. Coming back to that later, but there's an order block here. You come here, you retest this order block, and you pump back into the resistance. Now this is an outlier we created. This is the sell side liquidity, and this will be swept in the future. So people could have shorted this, but people like me who just trade spot have to long, obviously. So we have to wait for the entry models that I've marked in the bullish side. So I did not take this trade actually. Was of course asleep as usual, but this is the sell side liquidity. This is the sweep happening over here for the sell side liquidity. And now coming back to the picture, you see that between the sell side liquidity and there's the sweep, there's a distribution period. Now you can see then from here to here, there's this thing here. This is the distributive period. This is where distribution is taking place, bearish market structure is taking place, supply is being created, whatever that is, it is what it is. But focusing on the main thing, you have the sell side liquidity. Let's just mark it like this. Sell side liquidity here. You have the sweep over here. And then you see again that the candle closes bullish and there's another outlier candle created over here, a particularly larger wick than normal. What happens in the future is this, that the price revisits this wick as well, but it does not sweep. Why doesn't it sweep this time? Because this is the higher time frame structure, and the higher time frame structure is always on top of the lower time frame structure. This here is the lower time frame structure, and it's not essential for a lower time structure to do exactly what you plan based on the higher time frame structure. On the higher time frame, a sweep is done. Sweep is done, you have your trigger to take a long. You could have taken a long over here on the retest. You could have taken a long over here in this order block. Let's mark the order block right again. You could have taken this This is the 15-minute order block here. You could have entered here, here, here. There's so many entry points over here, right? There's a double bottom, triple bottom. There's another lower time frame range here as well. So when we say that you have to take trade confluences, this could be an example. You have so many things happening here based on the initial plan, which was the sell side liquidity being swept over here and then reclaiming very easily. Could be a scalp long. Now, talking from the take profit side, this is the take profit on the first market structure. This could be anything, a supply, blah blah blah, market structure break, anything. And there's the BSL, which is the opposite. You can see this on BTC right here as well. There's for the first thing you have here, if you do just like this drawing, you have this, and this thing happening over here, right? Like this. So this is the high that was created for the market structure, and this is nearly where price has rejected, besides 51,936 being a key level of the range. That is your first take profit. Your second take profit could be a buy sell liquidity, but there's no actually buy sell liquidity right over here. Not really a good one, but if I fluctuate between the time frames on the 1 hour, you can see that there is actually one. So you can just go for like this as well on BTC from here. But the main thing is always this first high that created here for the TP. That's in the thread I marked it as TP instead of BSL is TP. That TP is more important than BSL. And there's also a bearish order block here that coincides with the market structure of the take profit. So model one should be clear now. It does not happen a lot, but a very easy one if you know how to incorporate the higher time frame into the lower time frame. Okay, now we are going to move on to model two. Before we get to the next model, I just wanted to add in this thing here that you do not limit order the sell side liquidity or the buy side liquidity if you're shorting. The reason is because if you had limit ordered this thing here, let's say we are placing this here at now, the thing that makes your setup is your take profit plus your stop loss. If your stop loss is like this here, there's a 5 hour trade. If it's like this, 1.5 hour trade. So the stop loss makes a really big difference. Now, when you are placing a limit order directly into the sell side liquidity, there's actually no support here. You could say that this is the major support, that if it goes lower than this, then it's going to go down. But then you have this major SR flip over here. So can you actually place your stop loss like this? It can bounce here, back up. You can place it like this. It could potentially wick here, bounce back up. So there's so many conspiracies with placing a limit order at sell side liquidity. You have to do it manually. So manually, like we discussed, wait for the sweep, wait for the sweep to reclaim, then find entry triggers from there. And if you just talk about it like that, let's say it was the sweep over here, the candle closed above, it came for a retest somewhere over here. You could have easily placed your stop slightly below this previous sweeping low, or you could have used a manual stop in this case as well if you're unfamiliar with wicks. And this could have easily been like a 3 to 4 hour setup. Okay, now let's just get directly to model two. The second model is the equal lows sweep. This is so good, you can't actually believe it. I use it all the time. Equal lows in simple terms is a range with so many lows, so many lows, so many lows that it becomes so obvious that there are stops placed below. And there's actually always, not always, but mostly an imbalance below those lows as well, such that people who place their stops are either wide stops or they are tight stops. There's no in between. For the tight stops, that it's just below, slightly below the equal lows, and if it's like wide stops, it's like fully below the imbalance. So to identify this or to use this model, just identify the equal lows, then identify the supply or demand or bullish order block below the equal lows. Now to demonstrate this with an example, we have this already thread here on my Twitter. There's the first SR flip thing, then the thread is continuing, fail, got stop break even. Then here on the last tweet I mentioned that there's this SR flip right there like normal. Then you can see that there are equal lows over here, right? And below the equal lows, there's an order block placed. And this picture is not so clearly visible, but let's come over here. This is the equal low structure, all right? Price is just moving. Now talking about the stops, I was saying there's always imbalance, not always, but mostly again. And people either have stops slightly placed below the equal lows or completely below the imbalance. Stops could be here, stops could be here, or stops could be here for the tight ones. We are not actually caring about what the stops are doing. We have to find our own entry model. So we identify the order block to be over here. We mark the order block. We can place a limit order. Yes, in this case, you have to use a limit order because you're placing right on the order block, and you won't have much time all the time to be waiting for manual configurations to follow through. And then over here in this exact tweet, we got the bounce from the range low from the order block, which was over here, and we took profit over here because this was a really big supply. I took this profit. Where did I take this profit? I took this profit over here for 0.65 hour, not much because the stop was really wide. See, it's like below the imbalance as well. And people were asking in Discord there, why did you close it? It looks so good. Did the reclaim? Then I told them about the Model 12, which not Model 12. There's another model actually. Don't remember the number exactly. It's called fail auction. We're gonna get that to later on how you have to take your first model and then you have to keep in mind other bearish models to follow through on the take profits. So this was the high time frame supply over here. Let me just mark that. This is the whole supply here, and I just closed it manually here, and from there it just kept dumping. All right, that's good to take profit early, cut losers early. You don't have to wait for things to happen all the time. Simple point to note: identify the things where it's just ranging, lows, lows, and those lows are eventually going to burst through directly into a demand or block and follow through with a bounce. And this is where you can make the easiest form of money. Now let's get to model 3. Okay, so here's model 3. Just from the picture, you can see that this is actually really confusing, and I hate trading this. But if it's there on the chart, I can't just say no. I can't say no to free money, all right? So we have to trade it. This is confusing, so let's just do it in a bit more detail. You have a structure, random structure, just like I randomly do. The main part is here. You have a range low, could have a range high as well, but for the purpose of this model, let's just say there's a range low. You have a weak high created when the market structure is in its phase of creating a change. You have a weak high, you have a deviated low. The deviated low is not necessary, but if it's there, it's good. Okay. And then there you have a break of the weak high, which we call the break of structure, reversal, and a point of retest where you take the entry, you take your first take profit on some of this SR flip that may come over here, or you take it back to the range high. Now, if we go to this chart of TR right here, all right, can you identify that exactly where it is just by looking at it? No, I can't do that either. So we have to just go around, mess around, zoom in a little bit, zoom out a little bit, and see things. And the best way to do these things is first of all, look for the outliers in this thing. Start from the left to the right, all right, because the chart goes from the left to the right. In this, I can see that there's a structure forming over here like this. I can see some outlier wicks over here. I can see that there are some equal lows over here. For the other model, I can see that there is a demand zone over here as well. I can see there is a range high, there's a range low like this over here, and a break and retest of this range as well here. Many things I can see, all right. But for this model, I have to identify first the range low. Okay, let's just do that. Let's identify the range low. We could say that this is the range low over here. All right, could be from this candle body as well. But the wick is better, so we'll say that it's better on the wick. All right, but if you take it from the example of this retest, the body makes more sense. So let's, for the sake of this chart, let's consider the body as the range low. All right. The next thing we have to identify is the weak high that was created or the deviated low. We can see that when the market is trying to change structure, there's a weak high set in this area anywhere. Because in this specific area, you have a buy sell liquidity created here, and on the lower time frames, you will have some supplies, but not really some strong supplies. Just by looking simply at these candles over here, let's just talk in terms of colors. You have different colors, green, red here. But in this specific area, you just have red candles continuously going down. Now there are candle pattern names as well for some of these candle structures, but I never use them, neither do I know about them. I'm just identifying on based on what I see right in front of me. So I say that this is the weak high. All right, and I see my deviated low over here as well. I have identified my weak high to be here, and I have identified my deviation to be here. And if I want to elaborate it, I have the order block here. Okay. The next thing is we see a break of the week high, then the retest towards the range low. Now over here, we have a break of this week high. We come all the way back down. We not exactly retest the range low, but because there was an order block over here, your entry point would start from somewhere over here. Okay, and that is it. Now going towards the TP, you can TP at the SR flip or back towards the range high. The range high, we said that we could see the range high coming from here, here. To make it more precise, let's say that this is a range high. Okay, we place the take profit here and we place our stop below the deviated low. You have almost a 2-hour setup right there from this model I call the breakout structure. This is not as easy to identify as the others, but it's still a valid model that can be used. Now, thinking from that perspective, from the difficulty of this model, how many people do you think would have been present over here trading this move? Very few. Because for most people, these moves is what they supposedly call chops. I don't actually believe in chops. If the market is sideways and I'm not able to get any good trades, that's my problem. I simply don't know how to trade. The market is never choppy. The market is continuously moving. You just have to adapt to how the market is moving, get fine trades based on that. Okay, that's model three. In these 12 models, this is the most difficult one, but remember this one as well because it is really important. And let's move on to model four now. Model 4 states that it's a range low sweep. It's like the equal low sweep, but instead of the equal lows, look, it's going back into the order block or demand as well. Instead of going back from the equal lows, it's going simply just from the range low. Exactly like model 2, just the difference of being range low. Now simply let's just go and try to identify if we can find one of it. And let's just try to identify it on this chart if we can. Hmm. Okay, I see a range here, but I am not exactly sure if it tapped into the order block. So let's just mark the range first. You have your range high, you have range high, range low. Let's just say that this thing here does not exist. We are trading in the past. Okay, now let's go lower and try to see if we can find an order block. Okay, I saw an order block. Where is the order block? It's over here. So that is exactly the model right there. Just like equal low sweep, you have this range low sweep. The range low sweep is directly going into the order block or demand zone, and you are placing a limit order into it. Now, if you were in this trade and you placed, I think I was in this trade as well when I was trading TI and I posted it on Twitter as well. This was like a major market down where TI did this move. But whatever that is simply a really easy model where you target the lows to be swept below the range low or range high for shorters. In this video, I'm just going to be talking about the lows because I'm a spot trader. I cannot short, and all the models are based explained on the longs. You have a take profit. Okay, I forgot the take profit. You can take profit at the nearest OB or supply, or you can trade it back to the range high depending on the market structure. Because in the past, you did not know the wick will be like this. So there's an order block and supply over here. You could have taken profit over here, but the wick got created. And you come to this chart, and oh shit, this is so bullish. This is such a strong buyback. Then you go for the range high, and you eventually go for all-time highs, which happened over here. If it was me, I wouldn't actually be holding until here. I don't have that sort of patience. I would have 100% booked my profit over here. Now, if you just incorporate model one into this chart, this is the sell side liquidity now. And in the future, I don't know when, but in the future, this is going to be swept. There is going to be a time the price is going to go like this, take this lows, and below these lows, there is demands here as well. Reclaim and go back up. So keep that in mind for TIA if you want to buy TIA cheap. This is a potential model one on TIA higher time frame, not even higher time frame, macro time frame. All right. Now on model five, we have range high flip. Let's just do it on this chart as well. Range high flip. This was the range high on TIA. You have a breakout, but right after the first daily candle closing above, you have this reversal candle over here. Okay, you go back down, there's a market dump, it's like sweeping this order block. This could be said order block, but this is an immature order block because the wick is way too large and there's a lot of stuff happening over there. So I won't consider this an order block. Let's just say there was something happening, mm, something bullshit happening. Okay, but the model that plays actually is over here. You see the range high. You have a really strong breakout over here. It's gone substantially high from the range high, and later in the future when it's coming back to the retest, you obviously buy over here. Now for this model again, you have to use limit orders. You can go manually, but limit orders are just going to work fine because it's unlikely that prices are just going to go from the retest like this. Okay, now, if you were in this trade, your stop loss would have, in my stop loss, would have actually been below these lows. And I would have most likely been stopped with this buyback on the daily candle. But the best thing about this model is that I wrote it in this text as well. Invalidation is simple. Manual closer rate price accepts back below range high. All right. You're taking this trade on the daily range high. Okay. You come here, you wait for the retest, your order gets filled over here. Okay, you start trading it, and price is just doing whatever it wants. But none of the daily candles have actually closed below the range high. So there's this big wick, but it actually hasn't closed below. So you're still in the trade and you survive the stop loss. This is the main point while trading the flips of range highs is that you should be focusing on the manual stops. Keep your size small so that you can compare it with the loss you take if the candle substantially closes below the range and it's not more than 1.5 hour. You have to keep a margin of like let's say zero point 0.5 hour on top of 1 hour while trading with manual stops. That is exactly what I do as well. So simple as that. If it accepts back below, the model has been proven wrong and you can cut your loss very early. And you don't have to waste time as well holding the trade, deciding to do whatever you want with it, and potentially missing other plays because it's a very good model. I use it a lot as well. Now, the sixth model is the GP inside MB, short for Golden Pocket Inside Imbalance. For that, we are going to use the example of XIUSDT. Okay, if any one of you remembers, this is my analysis for the future. I have an alert set as well. Let's just ignore that. If we go to Twitter and we search for crypto Bheem XI. Okay, XI almost TP after a month, closing here at 35% off plus $13,000. What was the XI plan? XI was inside this very big imbalance on the daily. Now, if we go on the daily, we are talking about this imbalance over here, okay, this one. And I marked my fibs, okay, the fibs, the golden pocket coming between the 0.618 and 0.706. This is the gray box. This is exactly the gray box on this chart here as well. Now, if you go to the profit chart, this was a retest of this box and back up into this major supply with the stop placed below this low. Now, what was happening over here is well, between this imbalance in this model I've stated, let's go back. All right, everyone has seen this. Let's go back to the model. You have the fibs and your entry points are between the 0.618 and the 0.706. It can be just the 0.618, it can be just the 0.706. So you can place limit at the first, DC at the second, or just place at the first. And let's just take a lesser RR setup than just simply waiting for exactly the 0.706 to retest because it may or may not retest. So we had the retest, perfect retest over here. Now, if you look at from the perspective of a lower time frame, let's just get rid of this green box. This entire imbalance, it starts from here. Look, it's completely up, up, up. When things are like this, up, 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 they create imbalances. You have an order block over here as well. But there's a range, there's an order block, but according to the imbalance, the golden pocket lies below the order block, just inside. Now, if the box wasn't here, or if the golden pocket wasn't here, there's just literally just some green candles over here. There could be an FEG here. I don't know. I don't know how to mark FEGs. But from a beginner's perspective, would they know that they have to place a limit order inside this place over here, like I did? No, not even past me would have known. So that's what makes a trader good because they have an edge that nobody else has. There was an order block. It was, according to my models, a potential place too long. You can see here when price reacted to this order block here, it reacted by deviating, replaying, reacting here again. But the main thing was this higher time frame structure, this higher time frame order block imbalance, sorry, and this higher time frame golden pocket inside it for the potential trigger point. So there can be instances where you have multiple models presenting itself in a trade, but you have to identify which way is on top of the other model and then take the trade based on that. I TP'd over here because all right here. I TP'd over here because it was in the supply zone. It came back up below to this range high retest. Again, you have this range high retest model over here on this order block here as well, and it just went for the all-time highs. That was a mistrade. If I had it on my watch list, which I did not like this, I could have potentially gotten a trade again on that as well for the continuation. Now comes patterns. This doesn't need to be explained. This is very, very basic. Everybody knows patterns. Just the key thing in this is that you have to keep an eye on the SR flips where the patterns are happening. Just incorporate the patterns into SR flips, and your patterns are going to start being more effective than they are without the SR flips incorporated. All right. Now we are going to move to model 8, which is the failed auction. And we talked about this earlier that we are going to move on to this. Okay. The model 8 states failed auction. Auction is a fancy word for a failed breakout because fancy words give us reach on Twitter. Just kidding. Or maybe I'm not. All right. So we're going to use my high time frame, or you could say macro chart, for this model. The eighth model states that you do all the fancy stuff like the other models, but it doesn't work out. Why doesn't it work out? Because you're not seeing the high time frame picture, or a picture that is supposed to be drawn by you and you haven't. What I mean by this is that the mother of Model 5. Okay, the Model 5 was the range high flip, retest in the order block, go up, up, high, up, blah, blah, blah. Okay, this is the BTC chart. Everybody knows this is the range high, this is the mid range, this is the range low. This is the 3 month order block for my future buys if it ever comes over here, for where I will sell my house, my kidneys, my everything, my testicles, everything I'll sell and buy BTC. Okay, so let's just leave that. This is the supply zone and this is the range. According to the model 8, your range high will attempt to do a flip, but and people will get bullish. You will get bullish, people will get bullish that this is a breakout, but the breakout will fail. What will happen is it will follow like this and whoosh. This is higher time frames. It could be on the lower time frames as well. I had it marked already on the higher time frame, so I'm showing you the higher time frame for my BTC future plans. What happens is that there's a supply, there's a breakout of this is the range high. Okay, all you knew it already. There's a breakout of the range high. You have an order block demarcated here. You long the retest and you start going for the highs. Since this supply is really large, you could be scalp longing here, but we are talking in perspectives of, for example, let's say a target of $100,000 for some. Let's just say I'm targeting $100,000 in BTC from on this breakout, okay, or the previous all-time high. I'll start to see something like this, something like this. Price will go into the supply, I'll distribute, follow the other models, and whoosh, down it goes to fill the imbalances. Okay, so I think there's not much more to say on this model. The 8 model simply corresponds to your other models and it saves you from a potential loss. So you have to keep in mind the 8th model happening while using the 5th model, or could be other models as well, that if you are trading a breakout or a bullish momentum continuation, look for a higher time frame bearish block there that could hammer down your targets in the opposite direction. The ninth model is momentum. This is a very interesting one as well. Just by summarizing this text, I can tell you that you have a breakout, you have an SR flip, you have continuation. What majority would do, let's just try to find it on, let's try to find it on AI because it's in my watch list. Mm, Trying to see for a breakout. Okay, I see one over here. It's not really good, but still there. Okay. Okay, you have a breakout. You have an S flip. According to model 9, momentum, why most people fail while trading breakouts is because they are not looking at the momentum of the breakout. The momentum of the breakout simply means that if a retest is going to happen, the retest should not be so deep that it invalidates the entire structure of the breakout. You see, you have a breakout happening from here towards here. Now, if price was to revisit the entire SR flip, it still would have been valid. But does it look from a retest over here, or does it look better from a retest over here? This is actually our order block over here, all right? And according to that model in this picture, you see that the reversal zone is from the order block or the demand zone as well. And this is where people say that I got front run. This happens with me a lot as well. Most of the time when I get front run, except the wicks that people buy back by front running my orders by following the calls on Discord and whatever, my losers, actually losers that I'm not able to fill is because of this thing. I'm not seeing the order block that is right above the SR flip. So would it be better if it retested and went from like this? Or would it be better if it went for the entire retrace? Now the entire retrace is the measurement starts from here. There's only this much left over here that it has not retraced back. So momentum states that when the retest starts to happen for a breakout, it should not lose the bigger picture. The bigger picture is this entire breakout. The momentum should be there, and you see you have a retest in the for the full entire SR flip in the future as well, and you have a bounce, but the bounce eventually breaks down, does the deviation, reclaim, and then back up. There's many things happening, but if I draw it again, if you have a breakout from here like this, instead of waiting for price to come back like this, some people actually use this thing as well. They go like this and they say, okay, let's wait for the exact pinpoint trend line retest. This happens a lot on Twitter. I see a lot of posts like these. Instead of going for things like this, you should wait for things to do something like this instead, because this represents strong buy pressure, momentum uphold, and generally just buyers being present and interested to keep the trend going in the direction it was supposed to go instead of chances being created for the trend to reverse. Okay. The next one is the R block over R block. And this is one of my favorite ones once again. And for this example, if anybody remembers my tweet on say that I tweeted out again today that I got front run by the size of people's orders, sadly, but I'm keeping this limit still here. The order block inside order block states that you will have an order block and then you will have another block order block inside it. You have to wait for the higher time frame order block to hit and then a bounce and then wait for a lower time frame order block inside it to fill and then continue upwards. Why is it essential that when the first, let's just say this is actually a supply, this is another model, model 12, where the supply is flipped, but there's an order block inside there. So for the purpose of this model, let's just say this is a higher time frame order block. Let's just say this is the lower time order block. You have the first step here. Now you can see that there's a range low here as well. There are EQ lows over here as well. There's the range high. Now price has reacted first inside the higher time frame order block, but we are going for a better entry on the lower side of this high time frame order block, but inside that higher time frame order block is another lower time order block, and you can place your setup something like this, and you have like a 4.6 hour setup. This is my 4.6 hour setup. You can mess around with the stop and do other things as well. But the entire purpose of this thing is that you look for a better RR setup. If you're unsure of the market, that is it going to continue from the higher time order block, or is it going to retest the lower time frame order block inside the high time frame order block, then you go see BTC. You say, oh, BTC is at res and my chart is at like the exactly at your order block. I'm expecting a bounce. So if you see that BTC at res, you just simply go with the next order block. And if BTC, like just say, comes back to the support, you set an alert here. The next support of BTC is matching with your next order block, then that's a green signal. then you can take the trade now, because that's the highest probability that price is going to reverse exactly from there, and you can trade, potentially trade the close at the earliest, instead of waiting when you should close this, take a loss, and then move on to the next trade. All right. The 11th model is the AMD, accumulation, manipulation, distribution, or PO3 for short. This is very widely used on Twitter because it's very simple and you can identify it everywhere. We can identify it in this chart as well. Let's just go to the same chart on a different exchange because I don't want to mess up my drawings. Let's just say how could potentially a PO3 be setting up over here. Remember that I told you that my smaller order block is somewhere like over here, all right? Let's just say that's my order block. We mark our range again as well. Range low, range high, and we make this favorite curve of mine. Okay, here. Now we are trying to identify the PO3. Here's my brush. PO3, you have accumulation, you have manipulation, you have distribution. You have accumulation, manipulation below the range low at the order block or demand zone. It's written in the text as well, and then distribution. You have the order block, you have the range low. The range low is breaking down. People are, oh, we are turning bearish, fuck, short. But from another eye, you can see that you have accumulation, potentially manipulation, and then distribution from there. And price will go something like this if it goes. It's obviously not guaranteed to be that way. And the best way to trade is by not placing limit orders, actually, by waiting for the manipulation to complete, reclaim the range low, trigger your trade over here back. You'll get a higher RR as well. But if you're someone like me and is more lazy and can't just wait for the manual reclaims, then just place the limit inside the potentially high time frame or strong order block. Wait for a bounce. It comes here for the bearish test. Move your stops break even from here. And if it wants to follow through, it's going to go through. Add more here if you want, or just hold the other one. And if it's not, it's just going to come back here and break down further. There's very rarely it's going to do something like this. Okay, slicing through staff supports or blocks, especially high time frames, is rare, and it only happens if there's a complete full-blown market nuke. Easy model as well. And let's just come to our last model, which is the Model 12 supply flip. This is something I use as a lot as well. And I showed you this on say, this is the supply flip, but let's just go with someone else. This is my current trade, which I've posted in Discord. I'm currently in this trade, and we are going to apply this model on this one. Okay. Simply, you have a large breakout here. I can see from the breakout over here that there's an SR flip, but the most important thing here is supply, this supply, which is flipped. The supply or the demand for the supply is from the upper wick to the body, and for the demand, it's from the lower wick to the body again. All right. You know that thing if you have watched the main video I've stated in the start of the video. Now, here we have a supply flip, we have a tap, we have a small reaction over here. If I go deeper into the time frames on the 4 hour, in this exact same supply, I have another supply over here. Okay, I can incorporate that for an entry point as well. So if I did that, my entry could have been here, my entry could have been at the body here as well. Could have been many options. Now, now we have done the harder part. Okay, we have identified the supply, we have identified its flip, we've taken the trade. Now we have to see how we go about this trade. In this here, you have another supply zone here. We have a rejection here as well. Now this supply is going to act as resistance in the future. On the flip side, you have an order block created over here. Now what I can do is that I can, since the trade has moved in my direction, it has made an order block as well here. Price can go for something like this. Now, if it does go for something like this, when price has bounced from here, shows a reaction, reach this point, I'm going to move my stops to break even. Until then, I'm keeping the entire setup as it is like this with a white stop. Now, for a continuation back towards this supply over here, okay, you have another supply over here, and we are taking it to supply. I think this is the weekly open as well. Yes, it is. My TP is at the weekly open, and I hope that it goes there this week. Now for a continuation, and if you want to add, you have supply here. First we said that this is the supply. Okay, price broke out, retested, we took a trade. Now there's another supply over here. You're going to do the same exact thing over here. You're going to, let's just go into the lower time frames. Supply, what you're going to do is you're going to wait for this plan to follow here, going to wait for this supply to blow through, going to wait for a retest of this supply. You're going to move the stop to break even on this long, and then you're going to take another long over here, add to your longs, take the continuation back to the weekly open. This way you compound your trades simply, and you just keep on adding and adding and adding and make your PNL bigger and bigger and bigger just by following a lower time frame model into the higher time frame model. I hope it was clear, and yeah, I think yeah, that's it. These are the 12 models. They were very basically explained in the text, but this is going to be a long video. It's going to take long to export, upload as well, but after 5 months, I thought if people are asking for it, then maybe there's a chance that somebody has not understood some of it. So hopefully that this video is enough, and I again don't have to upload for the next 20 years. See you in the next one. Goodbye. Actually, by the way, if you want me to make money for no reason, you can sign up with my Bybit link, which will be in the bio. I already have money here. I already have money. I don't need money, but money is money. And if you want to make me more money by simply just using the link, if you want, then you can. The link will be in the description. See you. Bye bye.